Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Prashant Nair. Hi, Prashant. We were cruising along nicely on the markets, flat, but suddenly in the last 10 minutes, there has been a sharp slide in the markets. We've dipped about 30 points on the Nifty, the Sensex lower by 100 points. That intraday chart will show you the picture. It's courtesy the HDFC twins. HDFC Limited as well as HDFC Bank have seen a sharp slide mirroring the losses that you can see on the benchmark index. So it's that vertical slide in these two heavyweights which is dragging the markets lower. But apart from that, even other stocks like Tata Consumers, Asian Paints, they're at the low point of the day. So they continue to see some amount of profit booking. So all in all, we've seen some selling come through in the last 10 minutes or so. The cut is not much. The Nifty is still holding on to 17,900. And for the week, if the Nifty continues at these levels, we are likely to go home with a gain of 1.3%. And this would be what? The fifth consecutive weekly gain?
Yeah, fifth week of gains. And I think you can bet on that. At least that much, right? That it'll be up week because, just down 40 is nothing. So unless you imagine that in the next few hours to close, we will be down 1.5%, I mean, it'll be an up week, fifth straight week. I mean, tremendous strength is what we've seen all around for so long now. Let's just take a look at the market breadth, which, by the way, is not great. We're up. We got 1,150 stocks which are higher and about 900 stocks which are lower. We ended yesterday's session with advanced decline pretty similar to this, not in terms of numbers, but broadly, the ratio was something similar. And I think, this has kind of slipped a little bit over the last couple of days, as have other indicators like, daily momentum indicators, perhaps. So it's not a raging kind of market, but it's a market which has been slowly but steadily moving higher, like the day before yesterday. And of course, yesterday was quite remarkable. Many dips through the course of the day, some to the tune of 70, 80 points, but ultimately all of that was bought back. So I think the advantage very much, even with this 50-point pullback, is with the bulls, unless, of course, prices tell you otherwise. We were talking about the daily RSI readings, relative strength index readings, which tell you if markets are overbought. We are at 80 plus 10-month highs. Okay. So at some point, there will be maybe some kind of lethargy which will kick in. Maybe not a correction, perhaps market goes sideways, but prices have to tell you, and they're not telling you that right now.
But what they have told us in the last 2 days is that we are consolidating. So markets can, at least the last 2 days, I'm saying it's been hovering around that 17,900 mark. So it's not got the legs yet to make another dash towards our all-time high levels of 18,300. So we're just spending some time consolidating the gains. But lots lined up on Trading Hour. Let's tell you what we have for you in the show today. Market are off the opening highs, currently trading with minor losses. Financials, pharma, FMCG stocks lag, while IT and energy show resilience. We'll discuss the way forward for the markets with Swati Kulkarni, Executive Vice President, Fund Manager at UTI Mutual Fund.
We'll have the management of IOL Chemicals joining us. Sanjay Chaturvedi will be with us to discuss business outlook. Raw material prices for their business has been a big problem area. Is that easing up a little bit? So that conversation coming up.
The recent movie releases have had a tepid response. What's the way forward for exhibitors like PVR Inox? Karan Taurani of Elara Securities on the show.
Spends data from the Reserve Bank suggests that more people have started to move from cash-based usage to digital today. This is what we will sort of point to in our special segment today. Fin Street, we'll look at how spend behavior is changing in India. So that coming up as well. But that's a little later here on the show.
Let's invite the first guest on the show now. IOL Chemicals is in focus. While the stock is down 38% from its 52-week highs, in the last 2 days, the stock has moved up. Today, up 2%. But yesterday as well, the stock showed you a gain of 7 to 8%. Sanjay Chaturvedi, the CEO of IOL Chemicals, now joins in to talk about business. Mr. Chaturvedi, morning. This is Reema here. First on margins. On a quarter-on-quarter basis, you've seen your margins improve to 10%. But your guidance for the full year is 15%. How do you plan to scale up your margins from current levels? What will drive it?
Okay. So what will drive is, the volumes of the business and also better realization on prices. As you've seen from last quarter, where we were down in the single-digit EBITDA, this quarter we've come to about 11% or so, 10 point something. And we are very, very confident that going forward, we will go to between 15 and 20%. What is helping us is see some raw materials we've seen easing. There was a period where the raw material pressure was very intense. And in some of those products, we've seen that easing off. And the prices of the APIs haven't really come down. So that would help us. And, I want to give a context here that what happened to, not just IOL, but overall the API industry at large is, we got used to a lot of KSMs and intermediates coming from China. And what has been happening in China is, one is certainly COVID related, and the other is the energy prices in China have gone up dramatically in the last couple of years. And therefore, the prices of all raw materials and KSMs that are coming from China have gone up. Whereas the end prices for the formulations, because of the National Pharma Pricing Authority on the formulation side, have kind of stayed the same and in many cases come down. We've seen cases where companies have made a request for the formulation prices to go up. And I think the API industry is kind of caught in the middle here. So I certainly think that the worst is behind us. And we are very optimistic in terms of growing our business, both on the chemical side and the pharmaceutical side. And more importantly, growing the non-ibuprofen segment of our pharmaceutical division substantially more than the ibuprofen part.
Just getting some numbers in, 15 to 20% on margins. Will you get back to that level by Q4 FY23?
Yes, we would get back to that level.
And it will sustain at these levels. This would be your medium-term margin guidance?
Yes.
Okay. You spoke about improving the non-ibuprofen business. How much does it contribute currently? What would you like it to reach up to? And you're also very bullish on the chemical segment. Could you talk about those plans?
Okay. So first I'll talk about the split between the ibuprofen and the non-ibuprofen part. We have already, non-ibuprofen already contributes about 35% to our total pharmaceutical revenue. And we think in the next 12 to 15 months, this number will go up to about 50%. So, the non-ibuprofen part and the ibuprofen should be almost equal in the next year, year and a half. The second question you asked me about was our investment plans in specialty chemicals. Yes, I'm happy to say that we've identified products that we want to be in, and we will be spending about 300 crores somewhere in the western part of India to set up a greenfield manufacturing for specialty chemicals. The portfolio of products has already been analyzed, and we are very confident of the technology. So the products that we get in will be based on three criteria. One is our technical capability. Second is our supply chain capability. And the third is our market relations based on the customers that we serve already. So in other words, what I'm trying to tell you is that the amount of de-risking that is required has already been addressed. So we are very, very confident that when we make this investment, revenue will start coming within 1 quarter of the plant commencement.
What is the growth rate for the pharma business? And in that, if you could break it up in ibuprofen as well as non-ibuprofen in terms of your growth guidance?
Okay. So I think the growth in volume has been there in ibuprofen, but in total value terms, it has been muted. And that's primarily because that product took, price decrease. But if I look at the non-ibuprofen part, I'm getting growth both in volume as well as prices.
Could you put some numbers in for the volumes and realizations for both ibuprofen as well as non-ibuprofen?
So in terms of growth, I would say that, the ibuprofen will grow in single digits, whereas the non-ibuprofen will grow in double digits.
Okay. Can you tell us about the key products for the non-ibuprofen? Because over there as well, there was some significant price correction, right?
Yes. So, our key products are metformin.
And paracetamol.
Yeah, paracetamol, we have, and paracetamol, as you correctly mentioned, has seen a significant price correction in the last couple of months. But other than that, we have clopidogrel, which is Form 2. We have, pantoprazole. We have levetiracetam. We have, a host of, fenofibrate, lamotrigine, a host of other products as well.
Okay. And your future plans also include exploring new geographies, and you want to de-risk the business with backward integration. Could you tell us how you're planning to achieve it, which are the new geographies, and what will be the capex required for that?
So, as I said, the new plant that we plan to put up in western part of India will be a combination of specialty chemicals and certain intermediates. Some of these are intermediates that would play into our existing product portfolio. And we are also doing a lot of R&D and pilot work currently. It would take us maybe at least another quarter or two before we can decide, the scale of the capex required for intermediates.
This new plant in Western India, I believe you've not even finalized or bought the land for it. But you still
we have not finalized. No, we have not finalized the land for it. We are talking to, a few experts. And I think in the next coming weeks, we will finalize that.
Okay. But it will still be up and running in 18 months? You will be able to start production?
Yes, certainly.
Okay. All right, Mr. Chaturvedi, we'll leave it at that. Thank you very much for joining in. That's the word coming in on IOL Chemicals. Confident the margins have bottomed out in Q1 from the current levels of 10.5%. They will expand to 15 to 20% by the end of the year. And the company is looking to grow its non-ibuprofen business. It's currently about 35% of the pharma revenues. That will go up to 50% of the pharma revenues in the next 18 months. And they're focusing a lot on specialty chemicals as well. They have a plant which is going to come up in Western India, for which they have outlined a capex of 300 crore rupees. And that will help them grow their specialty chemicals business a lot faster as well. For the markets, Prashant, the cut has accelerated. When we started, we were down 30, 35 points. The Nifty is now down 70 points.
Yeah.
Sensex down 250.
Yeah, it is, and sharp cut actually. And the cut emerged. I mean, the sell-off started at about 10:45 or so, and it's basically picked up pace at about 11:05. And there's a sharp cut. But, we saw something similar yesterday as well, not once, but more than a few times. Eventually, the market pulled back. Let's see if it's able to do that once again. But even with a 80-point cut, the fact is it looks large, but look at the context. I mean, the move from the lows of June all the way to 18,000, and now we basically got not even a 0.5% kind of pullback. And the point is, even that has not been lasting, and the market gets bought in very, very aggressively. The sentiment, I think, is still very bullish. It's also true that most are expecting some kind of a pullback, some kind of halt, pause, whatever. And if that is true and amplified in a very big way, then those falls really come. I mean, those pullbacks, turnarounds come when least expected, and now is not one of those times. Most that we speak with on the channel here and otherwise are expecting, things to slow down a little bit. Some even saying that maybe we get a meaningful pullback. We'll take a quick break here. We are back more on markets and, of course, specific sectors, etc., in a bit when we come back.
Market's still struggling. Nifty is below 17,900, but a stock which has been under pressure of late is PVR. Now, the PVR stock price in the last 1 month, in fact, in less than a month, has fallen from levels of near 2,200, and it's now down to 1,850. So that's been a serious fall that we've seen in the stock price of PVR since the beginning of this month. The problem is all the new big Bollywood releases, which have big stars in them, Lal Singh Chaddha, Raksha Bandhan, or even some Shera, all of them have not done very well at the, in terms of the amount that they've raked in. And that perhaps is putting pressure on PVR as well as INOX. We're now joined by Karan Taurani of Elara Securities to understand what the way forward is for all these exhibitor stocks. Karan, that is the first question, right? It's been a lean run for the theatre companies. in terms of what you've picked up in terms of the occupancies, how is Q2 going to shape up for them?
So I think Q2 broadly is going to be a very bad quarter as compared to Q1. So you have a decline here, versus Q on Q, and you also have a decline here versus pre-COVID levels. So our estimate is that you could see a box office revenue decline of at least 30 to 35% this quarter versus pre-COVID levels. And this is primarily because of large films not doing well. Most of the films have kind of done even lower than our collection estimates, which were already below par. What has happened here is that clearly one was thinking that the backlog of content is going to work very favorably for the cinema chains. But I think that is kind of backfired now, because most of this backlog are films which are probably slated to release 3 years ago. And since the last 3 years, because of the pandemic, we are seeing a big shift in terms of the consumption and the kind of content the audience wants to watch. And I think that's the reason for most of these films not doing well. And I think this is going to continue for at least 2 to 4 months now. We might see some respite only towards December, which is CY22 or probably the start of CY23, when you actually have got a new kind of content, new kind of scripts which are going to come in the Hindi film industry.
So Diwali as well, there are no big releases lined up, and have the stock markets priced in that Q2, Q3 is going to be weak?
So I think Q2, is weak, and that is largely priced into the stock. Q3, there might be some rebound on a Q1Q basis, but again, when we compare that to pre-COVID, there won't be much of a huge growth that we're expecting, because there are films lined up in Diwali as well. There are films, lined up during the New Year and Christmas season as well. But I am expecting a stronger rebound only towards Feb, March, because usually what happens is that, we've seen this in the past as well. I mean, when Bahubali came in, you saw a huge series of flops by large actors, and things actually started to pick up, 2 to 3 quarters down the line, when a lot of the producer directors kind of rechecked their strategy. So I think we are at the same time right now, where you'll see 2 to 3 quarter of transition, and maybe from here on the third or fourth quarter onwards, you will see some uptick.
When you say Q2 will be bad, how bad do you think it will get compared to, say, Q1? What is in your numbers?
So if you look at the box office revenue, Q1, we did a growth of about 13%, 13 to 15% in terms of box office revenue for Hindi. And, for the multiplexes, this number was largely around 20 or 18 to 20 odd percent. But you have to note one thing here: whatever growth that came in, it only came because of ticket prices. So ticket prices have moved up in the range of 15 to 25% for both the exhibitors, whereas the footfalls are still down close to 10 to 12% versus pre-COVID levels. So all these comparisons are basis pre-COVID levels. I think next quarter, what you're going to see is that we are expecting a 35% decline as compared to pre-COVID levels. So maybe the ticket prices will sustain with a growth of 10-12%. But the footfalls will see a sharper decline of close to 35-40% as compared to what you saw in Q1, when the decline was only about 15% versus pre-COVID levels.
Could you help us compare it with Q1? We've got the Q1 numbers up on the screen, where the footfalls were 2.5 crores, the occupancy was 33.6% for PVR, and the ticket price average was 250 rupees. How would it compare with Q1? Your expectation?
So in comparison to Q1, as of now, we are seeing that could be at least 25-30% lower on a Q1Q basis.
Footfalls?
Yeah, footfalls.
25. And occupancy as well?
Yes, footfalls and occupancy both move in line. So that, yeah.
And ticket prices should sustain at 250?
I think ticket prices also will see some pressure, because I think in Q1 what happened is that, you saw the ripple effect of RRR. In the first week of April, you saw KGF 2, you saw Thor. These are films, which attract a very high ticket price. So ticket prices were higher versus pre-COVID levels in the range of 15 to 25%. I think that will come lower towards the range of 10 to 15%.
What are the other big releases? You have some interesting ones are lined up in Diwali as well towards the end of the year.
Yeah, so there is Circus, there is Ram Setu, there is Maidan, there are multiple films which are coming in. There is Brahmastra, which is going to come in the first week of September. So there are films, which are lined up. We've got at least close to 7 to 8 films. There is PS1, which is a large film, which is dubbed into multiple languages. There is Adi Purush, which is coming next year as well early. So there are about 8 to 9 films, lined up, which are large in nature. And most of them have a budget of close to 120, 150 crores plus. And I think we'll have to wait and watch in terms of, how these films fare. But looking at the trends right now, I think clearly, the audience is not, wanting to just watch star-driven content. The consumption habits have changed massively. They want to watch, compelling content, quality content, compelling stories, or they want to watch, probably some franchise films, which is, part one. We saw Bul Bulaiya 2, which was like a big success. We saw content-driven films like Kashmir Files and Gangubai doing well. Or probably, something else in terms of the sci-fi, which is your VFX-driven films which are there. So I think there is a definite change here in terms of what the audience is expecting right now from the content. And that is kind of impacting frequency to cinemas.
Okay, the audience has gotten very discerning right now.
Basically, depend on, good quality South Indian stars, essentially, right? Karan, is that the takeaway?
Yes, absolutely. I mean, South right now is not considered just as South. I think they've done a fabulous job because they've moved away, from their, so those 5 states down South. And if you look at Hindi, I think Hindi that way has been a lag. So just to give you some numbers here in perspective, regional films get close to 30 to 40% of their box office revenue from the non-South markets or the non-regional markets, so to say. But, for the Hindi films, that number is, sub 10%, about 5 to 7% of Hindi films box office contribution comes from non-Hindi, which is the dub version, which is there. So I think that's the problem here. And, the dependence of Hindi box office is very high for the exhibitors. So pre-pandemic, I think Hindi box office contributed close to 60% of revenue, for the box office revenue of the exhibitors. During the pandemic, it obviously went down to 25-30%. But nonetheless, given the sheer size, the scale the Hindi film industry operates, it is the largest. It's got the largest footfall base as well. So I think the size or the contribution still remains to be at 50%. So unless this portion does not start outperforming in a very big way, you will always keep on seeing concerns on box office revenue for the exhibitors.
My question was only in jest, but none of you, both of you did not get No, I mean, point taken. By the way, that merger, Karan, is on, right? PVR Inox. You don't see any problems there. There was some news flow that someone has gone to court, I think, right?
Yeah, so I think there's a trust which is there. There's a trust body. I think CUTD. They've just gone to CCI to investigate into this matter, and you'll probably go against this merger of PVR and Inox. But I think I don't think there's a big concern as of now, unless CCI comes out with anything from them officially. I think this is just more of a noise which was created in 3-4 years back as well. When you had this F&B issue when a PIL was filed, wherein they were not allowed outside food. So I don't see that as a concern as of now. But yeah, if something comes out from CCI officially, then it could be. But nonetheless, just to give you a perspective there as well, close to, I mean, in most of the circuits, wherever they are in terms of states, it's only Delhi, which is one state wherein they have 60% screen share. All other states, they have a screen share of 35% or lower. So I think, from that math perspective, in terms of screen count, I don't think there should be an issue from CCI as well.
All right, welcome back. So the market's slipping a little bit. Let's talk about market technicals. Mitesh Thakkar is with us of earningswave.com. Mitesh, good to have you on the program. So finally, we are seeing that breather come through. How would you want to trade it?
I think, morning Prashant, I think this is the first time when we've got finally some kind of a negative crossover on the intraday charts. I think, on the hourly charts, etc. The indicators have started dipping sharply with this last 1 hour of candle. So I think now is the time when the first signal of correction coming in is being generated on the charts. 17,800, 17,750 is some kind of a support area. So while, we might not go down immediately today, but I think this will start a process which should see a good consolidation lasting for next few days. And eventually, I think, the correction might see us test 17,600 as well. So I think it'll be now the next few days of choppy period with some kind of a downward bias. I have 2 sell calls right now. In fact, in the morning also, we had a sell call, couple of sell calls compared to the couple of buy call sides. So we've been exploring some shorting opportunities. Buy call is broken down. That's a sell with a stop at about levels of 314.5 for targets of around 300. And the other one is Apollo Hospital, which has been declining for the last 2-3 days and now is kind of just accelerating slightly on the downside. So keep a stop at about 42.30 here and a target of around 40.80, 40.70 on the downside could be tested.
Mitesh, thank you very much for joining in. So Mitesh expects this correction to continue and perhaps the Nifty could head down to levels of 17,600. And now his trades are on the short side. A quick reminder as we slip into a break, it's that time of the year again. Money Control Pro's financial freedom offer is back with added benefits. This is the first serious correction that the markets are seeing in the recent past. The Nifty is on the verge of breaking 17,800. We are currently down 150 points on the Nifty from the day's high. It's a cut of nearly 190 points, and the fall has been sharp and it's been quick. Just in the last 1 hour, we've seen the Nifty slump 150 points with the Sensex down close to about 500 points. But of course, as we've been saying, you have to keep this correction, profit booking in mind in context with the kind of rally that we've had over the last 2 months when the Nifty has rallied straight one way from 15,200 to now 17,900. Swati Kulkarni, the Executive Vice President and Fund Manager at UTI Mutual Fund, is now with us. Ms. Kulkarni, morning, and thanks so much for joining in. Should we brace ourselves for profit booking, or could it be routine profit booking down 200, 300 points, or do you think it could get deeper than that?
So Rima, first of all, good morning and thank you for inviting me today. See, I think it's very difficult for me to tell how much market corrections could be. What I know is, if you may allow me to spell the positives, when it comes to the corporate balance sheet, bank balance sheets, we are far better today in terms of the growth. Overall, we are growing, versus the other markets or other economies, we are growing better. We have our own demand, domestic demand potential. And yes, global growth slowdown does affect us a bit and external pressures are there, but I think we are in a comfortable situation. So that's the big picture for me. And when you talk about the corrections or the volatility, I think it's given, market had kind of rallied in last 1 month about 9% on the back of expectations that the inflation is likely to be lower. The commodity prices corrections have happened, but we can't just forget the global slowdown and also the narrative about some of the developed markets probably might get into a recession. So hard to call when exactly what, but I think it's better to look at the bigger picture and concentrate on what equity has for an person like Indian for wealth creation over a long period of time. So I would like to look at that way.
Okay, looking at the big picture and a longer term time horizon. Ms. Kulkarni, last month we saw the equity inflows, X of the SIP turn negative, and there was a sharp decline compared to the prior months. Has that trend continued in August as well, where the discretionary lump sum investments which used to come into the equity markets have dried up?
See, I guess a lot of people were sitting on the sideline as far as the lump sum investments were concerned, and a sharp rally of 9% in a month probably would have slowed down that, and people again would be waiting on the sideline, waiting for a correction. So I think this continues, but what you have to look again is that for the past few years, what we have seen is while the FII or FPIs have been selling out, we have seen domestic mutual funds mutual funds and of course the institutions are really holding the fort. And that's because of the structural nature that we are seeing, the structural changes that we are seeing. One, of course, is the SIP flows. Second, I would also mention that the PF and pension funds, which has a very long-term horizon, have also started to look at such opportunities where market corrects and on a ongoing basis, they are increasing the holding. And the numbers are reflected in the ownership that we have seen domestic institutions holding going up in the large indices like Nifty 500 or Nifty 50. And we have seen even though the FII holding has come down to from about 24% to about 20%, that has been absorbed by the domestic institutions as well as retail. I would say that's something which is leading to a structural, importance of equity as an asset allocation for Indians.
I know you don't take a cash call and you stay invested and you ride through all the market cycles and you have a longer term time horizon, but just wanted you to just give us a sense of how you are looking at the setup right now. Do you think just in the near term you would be a little more cautious, or you think we could see some amount of correction?
The cautious or conservatism is coming from the stocks that we select. So as, many times we have said that what goes into portfolio and what kind of characteristics we look for is clearly if the cash flow generation has been strong, the companies are making a good amount of return on capital employed, either higher than the cost of capital, or there is a pathway where it could see that improvement. That is, first of all, the base of stock selection. And I think as far as of course, the valuation is something which also goes into portfolio selection. So I would say that there are sectors like automobile, for example, or banking or telecom, where we think that next to couple of years, these sectors are likely to contribute for the incremental profits of the underlying indices. More than the sectors which probably are looking value oriented at this point of time, but there might be some issues as far as their profitability is concerned in next couple of years. So I would say that tactically we might kind of avoid those sectors at this point of time and continue to focus strategically on the sectors where we think the growth can be sustainable. And it's backed by strong fundamentals, be it in terms of the cash flow generation or in terms of the return ratios.
What have been the recent additions, deletions to your portfolio?
So I would say that, I've been positive on banking and financial sectors because, we have seen, as I said in the opening remark, that the bank balance sheets have cleaned up. We have much lower, provisions related, credit cost related impact on the profit and loss, and therefore pre-provisioning profit growth and your actual book accretion would be in sync. And also the capital adequacy has been strong. We have seen that private capex is likely to pick up, although in some pockets. Working capital growth has been happening, and we have seen it all reflecting into the credit growth. Of course, at this point of time, retail loans is a growing sector. It's growing at upwards of 18%, and probably industrial side is yet to pick up, mainly because India is also deleveraging the balance sheets. But apart from these, I think automobile, banking, these are some of the places where we have increased our allocation in recent past.
Okay, Swati, we'll leave it at that. Thank you very much for joining us today. That's Swati Kulkarni from UTI Mutual Fund. Let's get into a break on that note. Okay, before that, we've got a very special segment for you, Fin Street. Abhishek is standing by with a look at how the spend behavior is changing in India. Abhishek.
Well, in Fin Street today, let's take a look as to how the spend behavior is changing in India. So spends data from RBI does suggest that, more people have started to move from cash-based usage to digital. Data from RBI suggests that while the use of credit card has picked up over the past few months, the use of debit card and cash withdrawals have declined. So the share of cash withdrawal has declined from 62.6% in March to about 60.9% in May, but it is a tad bit higher in June to about 61.4%. Debit card usage in online platform has increased from 14% in March 2022 to about 14.35% in May 2022, but it is now declined to about 13.9% in June 2022. Credit card usage, on the other hand, has increased from 23.4% in March to about 24.7% in June. So what is happening to the infrastructure in India? The infrastructure for UPI and credit card have expanded over the past 4 months. Now, UPI QR code touchpoints have increased to about 19.5 crore at the end of June 2022, which is up from about 13% from the levels that you see in March. Now, credit card has also increased to about 7.9 crore cards at the end of June 2022, which is up about close to 7% from the March levels. So, infra method of usage of money is also changing with point of sale, or normally referred to as POS, and online transactions which have seen a rise in their share. So POS share has increased from 17.45% in March to about 18.3% in June 2022. Online transaction share has also increased by about 20-30 basis points over the last 3 months or 4 months. So ATM share on the other hand has declined in last few months from being around 62.8% in March 2022 to now around below 61.5% in June 2022. So along with a decline in ATM share, we are also witnessing decline in debit card share. So in the digital space, total debit cards in India stood at about 92.2 crore as of June 2022. However, in terms of infrastructure, its share has declined from 76.3% in June from about 78.03% that we had in March 2022. Let's now focus on the credit card business momentum that we had in June in India. So India has continued to witness strong growth momentum in terms of credit cards being issued, which grew by 2.4% month on month in June versus May. But total spends have declined by about 4.3% month on month, and average ticket size have declined by 6.6% month on month. This is a sharp slide of about rupees 1,000 in spends in a month. So, and well below the average that you have for the past 3 months. So in last 3 months, while the number of cards issued has increased by about 6.9%, the spends have increased only by about 1.5%. So top players like SDFC Bank, SBI and ICICI Bank saw a decline in credit card market share, while Axis Bank has been able to maintain its market share, and Kotak Bank saw an increase in its market share of credit cards. To sum it up, cash is being displaced by other instruments in spending. Penetration of UPI is seeing a big increase, as is the preference for credit cards.
Thank you very much for that insightful analysis, Abhishek. We need to get into a very short break, but as we do that, here is some important market opinion coming in from Ed Yardini, the president of Yardini Research. Listen in.
For traders, now is probably a good time to take some profits. I would say for investors, hold off. If you've got some cash, wait. There'll probably be another opportunity to buy it lower levels for the market. I do think that June 16th made an important low for the bear market. So I think we're in a bull market, but that doesn't mean that the market has to go straight up. I mean, the reality is it's hard to get wildly bullish here when you got valuation multiples really quite elevated. Typically, at the end of a bear market, the opportunities are that you can buy stocks at 6, 7, 8, maybe 9 times forward earnings. And now we're looking at 15 to 18 forward earnings. So they're not giving stocks away here. I think India does stand out. I think that's one of the reasons the market's done well is India does stand out as a safe haven for those who want to invest in emerging markets. There's certainly been a lot of volatility in other emerging markets and their stock markets.
Okay, welcome back. We've got the market, which is down 130 points. 17,824 is where we are at. So things are looking a little softer as compared to the last many days and weeks. Now, the government in its third fortnightly review of the Windfall gains tax has cut duties on crude exports. What does this mean for companies in the space? Sonal is here with details. Sonal.
Thanks a lot for that. Well, yes, in the third fortnightly review, the government has gone ahead and they have cut cess on crude production, which is positive for these oil producers like ONGC and Oil India. It has cut cess on crude, reduced to 13,000 rupees per ton versus 17,750 rupees per ton earlier. However, on the negative side, they've actually gone ahead and increased export duties on both ATF and diesel by 2 rupees per litre. So now for ATF, it stands at 2 rupees per litre. For diesel, it stands at 7 rupees per litre. The zero export duty on petrol stays, and these rates come in effect from 19th August, that is today. CLSA has written a note on these companies where they say that yes, it is good that the government is continuing with the fortnight revision, and the cut in crude cess implies post-tax realization of $77 per barrel versus $76 per barrel. And if we talk about the previous two resets, that was around $71 per barrel. So it comes as a relief because government is okay with realizations between $75 to $80 per barrel. What it also says is right now these stocks are really cheap. They are considering realizations of around $50 per barrel. So there is a position of upside from current levels. The negative surprise is that ATF and diesel export duty was increased. This would mean negative for the likes of Reliance Industries, where the impact would increase to $2.2 per barrel, and that is something that will be taken negatively by these refiners.
Thank you very much, Sonal, for joining in. The market fall seems to have abated. There is still no recovery in sight, but the Nifty is managing to hold on to that 17,800. It's a 130-point fall, but as you can see, the fall, at least for now, has paused. Let's also talk a little bit more about Sun Pharma. It's trading lower after the US FDA has issued a number of observations for its Mohali unit. My colleague Ekta is here with us, and she's going to tell us more. Ekta?
Hi, thanks for that. Well, yes, Sun Pharma is in focus because their Mohali unit had got inspected earlier in the month of August, and they had received around 6 observations. Now, the details of these observations, in fact, have come to light, and it seems as though it is going to be a road which is going to be a little difficult for Sun Pharma based on the observations to resolve these issues. That's what the analysts are saying at this point in time. Now, remember that Sun Pharma's this particular unit is actually an ex-Ranbaxy unit. It was acquired when they did make the acquisition of Ranbaxy. This particular plant had an import alert issued to it in 2013, after which it was in fact lifted successfully in 2017. But now there was these 6 observations which are issued. It manufactures oral dosages. Separately, just want to add that this probably weighs on Sun Pharma a little more, because just a couple of days ago we did speak about how their Halol plant was continues to be classified as official action indicated, which means that it is not out of the woods when it comes to the US FDA issues.
Okay, all right, Ekta, thank you very much for that. So that's Pharma in focus. Well, 140 points lower, 17,817 is where the index is at. Will this dip be bought into? It's possible it is, so don't count that option out. But for now, it's staying where it is. We'll take a quick break here. Actually, we'll take your leave. From Rima, me, everyone on the team, it's goodbye. Thank you very much for staying here on this edition of Trading Hour. More comes up on the other side.